So what we need to be able to do now is take our definition of a revenue and apply it to some examples to figure out is something a revenue or not. And all we ever need to do is basically, you're going to look at someone and go, yeah, I clearly know that's a revenue. I clearly know it's not. But you can't say that in your answer. You've got to kind of give a formal accounting definition answer. So what are we talking about? Well, whenever you get something, you're just going to go, is it a revenue or is it not a revenue? Because you're going to go, one, is there an overall increase in assets or decrease in liabilities that results in an increase in owner's equity, which arises in the ordinary course of the business's activities? So yeah, so it's just got to be an overall increase here or here, an overall increase here. And it can't be from a capital contribution. It's got to be through a business activity. So looking at that, all you ever want to do is get our definition and let's take a transaction. So let's say example number one, a business receives $10,000 from the bank as a loan. Well, let's apply the accounting equation to it. The accounting equation is going to just step you through whether something meets the definition of a revenue. So let's have a look here. So in this case, the business is going to get more cash. Cash is an asset. So that does seem to meet our definition here so far. But what also happens here is you get a liability called the loan. There's an obligation to pay that back. And that is it. So if we look at the accounting equation here, assets went up 10,000, liabilities went up 10,000, and nothing happened to owner's equity. So let's go through our definition. Is this a revenue? Well, you probably just know it's not. But why not? Well, you could say that, look, it meets one criteria in the sense that it does increase assets here. Okay, and it did occur during the course of the ordinary activities of the business. But then you could say, however, this is not a revenue because it does not increase owner's equity. Nothing happened here. Why not? Because a liability went up instead. So that we could say clearly that is not a revenue. What about this one? So let's take our definition and apply it to example number two. The business receives $1,200 cash from a customer from selling goods or providing a service. So what have we got here? Well, we've got an increase in cash of $1,200. Cash is an asset. And in this case, there's no other asset going down, or we're not going to owe anyone money after this, so nothing's going to happen here. So this is actually going to increase owner's equity here. Okay, so looking at that, you know a sale is a revenue. But why? Well, let's apply it to our definition. Assets is going to increase 1,200. Liability is 0. And owner's equity is going to increase 1,200. So let's go through our definition. This is a revenue because it's going to increase assets overall. It's going to increase owner's equity overall. And it arose during the course of the ordinary activities. So that one is a revenue. Let's try another example and apply it to the accrual basis accounting assumption. What does that mean? It just means net profit is calculated by determining revenues earned, not necessarily when the money or cash is received. We've also got this expenses incurred. We'll deal with that in a later video, but let's look at this. It just has to be revenue earned, not necessarily received. So let's take this example. Let's apply a definition to example number 3. The business sold goods or provided a service for $500 to a customer on credit with 30 days to pay. Let's apply our accounting equation. Now, does assets go up here? It does. An asset called accounts receivable will go up 500. No other assets going down. No liabilities going up or down. Overall, owner's equity is going to increase $500 because that is a revenue. We know it is, but why? Well, let's just step through our definition. We know assets have gone up there, 500. Nothing here. And owner's equity up 500. So all we're going to do now, why is this particular transaction a revenue? Because there is an increase in assets. There is an increase in owner's equity, so that's true. And it came about during the course of the ordinary activities of the business. Just step through it. 1, 2, 3. You got 3 sentences, so therefore 3 marks. So that's a revenue. What about this one? The business made a cash sale of goods for $800. The goods originally cost the business $300 to purchase. This is called a cost of sale. So we're going to deal with that later in the course. But for now, is this a revenue? Well, let's have a look here. Let's get the accounting equation. We got a cash sale of goods for $800. So we're going to get more money. Cash is an asset, that's gone up. Now, we've learned earlier that when we make a sale, that's a revenue. So that's going to increase owner's equity 800. But we've got to deal with this bit. This $300 of inventory that we sold, it originally cost us $300. So we've got less inventory. Inventory is an asset, so it's gone down 300. And it's going to be what we call a cost of sale expense. So it's actually going to decrease owner's equity, but we'll get to that later. The point here is, well, there's a lot going on here. What has happened overall? Well, assets have gone up 800 and down 300. So that's a balance of up 500. Nothing happened here. Owner's equity went up 800 but down 300, so it went up 500. So why is this a revenue? Well, let's go through our definition. Did assets increase? Well, it went up and down. So what does that mean? Remember, this is just overall. Did assets increase overall? They did, by $500. Did owner's equity increase overall? Well, yeah, it went up 800 and down 300, but overall it went up 500. So yes, that's true. And obviously selling goods occurs in the course of the ordinary activities of the business. So we've got a revenue. Just two more little examples here. Let's apply our definition to this example. An account receivable or debtor, someone that we made a sale to earlier on credit, repaid us $200 cash for a credit sale made last month. Let's apply our accounting equation. Is that a revenue? That's a tricky one. Let's have a look here. Well, first of all, we're going to have more money. This account receivable or debtor is going to give us $200 cash. So cash goes up. But this is actually not going to be revenue because nothing's going to happen here because another asset called accounts receivable goes down $200. If someone owes you $200 and then they give you that $200, well, now they owe you nothing. So this asset actually goes down and that's it. So if we balance all this out, the assets have gone up and down by 200. That's a zero. Liabilities is zero and owner's equity is zero, and that's okay. Zero is a number, so this balances. Something did happen. We're just saying the accounting equation balances to zero. But why is this not a revenue? Well, we're just going to go through our explanation here. Let's start with this one. It does meet this bit of the definition. It did occur during the course of the ordinary activities of the business. Okay, but our problems with these two. Did assets increase? Well, they did, 200, but they also went down 200. So this must increase overall, and it didn't. So it doesn't meet that part of the definition. And it didn't increase owner's equity. Owner's equity is zero. So there's two reasons why this is not a revenue. And just one more example. Because they are separate entities, the business and the owner can engage in transactions with each other. We've done this. So they're not the same entity. You've got the owner here as an entity and the business here as an entity. But remember, they can do transactions with each other. So the owner can give the business money, cars, property, whatever. That is called a capital contribution. But it goes the other way too. The business can, or the owner can take out these things from the business. Okay, when they go that way, that's called drawings. Now, let's just do the capital contribution ones. So let's apply our definition here to our final example. The owner of a business gave the firm $5,000 cash. That is called a capital contribution. Let's look at the impact on our accounting equation here. From the business's perspective, not the owner. We're doing the books for the business. We have got $5,000 more cash. Cash is an asset, so that's gone up. And we've got a capital contribution, so literally that is contributing to capital. So capital is going to go up 5,000. And that's it. Let's balance it out. Assets up 5,000. Nothing to liabilities. Owner's equity up 5,000. Is this a revenue? Well, let's look at our definition. Was there an increase in assets? Yeah, assets went up 5,000. Was there an increase in owner's equity? Yes, that went up 5,000. So at this point, we actually do have a revenue for this. But remember, a capital contribution is not a revenue. Why? Because there's this last part which says it's got to occur in the course of the ordinary activities of the business. That is not true in this case. Capital contribution shouldn't ordinarily happen. It shouldn't happen at all, really. But sometimes it happens maybe once, twice a year. At most, it's not an ordinary business activity. In other words, the business didn't earn anything. All that happened is the owner gave the business money. So in this case, we could say that is not a revenue.